Gaming and Tax. Tax aspects of M&A in the online gaming industry. Moderated by Ramona Azzopardi, WH Partners. With Daniel Lipman, HFN. Eduardo Gracia, Ashurst. And Gil Motti, Aspire.
So good morning, everyone, and thank you for joining us for this panel. We'll be discussing mergers and acquisitions and tax. So my impression, and from my experience in the gaming industry is very dynamic. So mergers and acquisitions happen very quick. And our role as tax practitioners is to prepare our clients to have their business ready for an eventual sale, a merger or an acquisition or an asset sale. And we as tax practitioners, we're always having challenges with the new commercial trends coming in, but also challenges in terms of tax laws. We have new tax laws coming in, both from an international tax point of view, from a European tax point of view, and also domestic. So together with my panel today, I have Daniel Lipman from HFN in Israel, Motti Gil from the industry, CFO of Aspire, and Eduardo Gracia from Ashurst in Spain. We'll be discussing the new commercial trends in M&A and how we as tax practitioner can help our clients to optimize their structures. So my first question is for you, Daniel. What are the current trends in mergers and acquisitions? So we know that recently there are new commercial agreements in fashion, like the spec, for example, which is more commonly used for when there is an Americans involved. What's your take on these new commercial trends, and how difficult is it to find the balance between tax optimization and dealing with these new forms of contracts?
Yeah, that's a great question. As you're aware, Herzog Fox Neumann represents a lot of clients in the gaming space, particularly clients which have a connection to Israel. And the SPAC is an interesting development, not only in terms of time to market and the regulatory implications, in terms of getting a quick listing in the US, but also in terms of tax. And the first question that clients will generally ask when they see the incredible valuations that a SPAC can offer them is, do we need a US topco? The answer is generally no. In most cases that we see, the clients ultimately end up in a foreign private issuer structure, which has both more advantageous tax status in many cases, as well as a more lenient regulatory position vis-a-vis the SEC. So often not a US topco, often a foreign topco, and that would be in the vast majority of cases, other than where there is a really clear connection of the business to the US, or they're looking to have a very high proportion of US investors in their structure. And the second question is, how do we get there? And generally, a reorg will be required in order to exchange the shares of the shareholders in their existing structure for shares in the SPAC vehicle. That may have tax implications. The tax treatment varies jurisdiction to jurisdiction. In Israel, a share-for-share exchange requires a tax ruling. In some cases, that can be difficult depending on the group's tax status. In other jurisdictions like the UK, it's permitted under domestic law, but subject to certain limitations in terms of how it's carried out. Sorry, go ahead. Oh, sorry. And for the Israeli shareholders, in some cases, a share-for-share exchange isn't possible or viable. And therefore, for many Israeli, or for some Israeli-owned SPACs, an alternative structure has been developed, which we'll call Target on Top, where basically the SPAC will be acquired underneath the existing holdco, so as not to require the shareholders to carry out that share-for-share exchange.
Okay, how important is that clients come to you before the actual sale and before, for you to choose also the jurisdiction? Which jurisdiction is the most important and to have the most tax optimization?
Yeah, it's a good question because sometimes these processes can take time. With some clients in anticipation of an exit transaction, we'll help them with a redomiciliation of their topco to a more suitable jurisdiction. So Malta, like other European jurisdictions, but not all, allows a redomiciliation of a company into and out of the jurisdiction. Some of our clients, in fact, carried out a redomiciliation in connection with a listing on various stock exchanges. So given those processes can take a number of months, it's often important to come early in order to have that discussion and be ready for when you want to start the process, pull the trigger, and move into those processes. And given that one of the motivations for a SPAC, for instance, is time to market, it can often be crucial to start the thinking early.
Eduardo, my next question is for you. Most of these mergers and acquisitions are financed by third parties or intra-group. And financing will inevitably give rise to interest, and interest is a cost. So how important is to tax structure in a way that then the group would absorb the cost? Because most of the time, it would be the borrower would be a holding entity with no trading activity. So how important is it to tax plan also ways how to absorb these interest costs? And how can we now do it considering most of the European countries have interest limitation clauses?
Yeah, well, actually, today it's difficult to envision an acquisition without external financing or internal financing to couple with the equity to be invested. So it's key to structure the debt suitably to optimize as much as possible the final taxation of the profit. There are a number of limitations nowadays. There is one which is very general, everybody knows, in particular within the EU after ATAT 1, which is the 30% EBITDA. So you cannot deduct more than 30% of your annual earnings before interest, tax, depreciation, and amortization of your net interest expense. That's, I think, general everywhere nowadays. But if you then consider a share deal rather than an asset deal, you will probably cope with some additional hindrance. In many jurisdictions, or at least in some jurisdictions, you find that acquisition financing is doubly limited because on top of the 30% EBITDA rule, you will have to live with a number of additional requirements. So that, for instance, the acquisition finance does not exceed X% of the share acquisition price, or that the acquisition finance needs to be amortized by Y% in Z years. So that is also part of what you find. And why that is important? Because in the case of a share deal, the debt will be at the level of the acquirer, purchaser, but the income and the profits will probably be only at the level of the target. So if you want to offset the expense with the income, you will need to consolidate, you will need to merge, and even in those situations, you will still need to comply with that additional requirement on acquisition financing to be able to really offset the expense and the interest. And thirdly, if it's intra-group debt, on top of these two limitations, requirements, you will then need to comply with transfer pricing concerns or requirements, not only on the interest rate, but probably also on the leverage, the amount of leverage out of the total equity of the borrower. both will be regarded, scrutinized quite closely by the tax authorities. And last but not least, if you are the borrower, you also need to factor into, when negotiating with external financiers, the gross-up clause. Because if you don't look at it closely, you may end up having an increase in your final financing expense by the level of the gross-up required to comply with the debtors, the creditors. The creditors don't like withholding taxes at source. So they will always try to push back so that the borrower has to absorb that extra cost when paying the interest. That's why it's very important to structure also the payment of interest so that lenders are in qualified jurisdictions so that you can avoid withholding tax, which otherwise, as I said, will probably increase your own cost as borrower.
Thank you, Eduardo. Motti, you're from the industry. So from your experience, what do you need to look at when it comes to mergers and acquisitions, when there's a deal in the horizon? How do you lead your company to optimize from a direct and an indirect tax point of view? And again, the choice of SPVs and the choice of jurisdictions, how important is it?
Yeah, so as in Aspire Global in the last few years, we are engaged in the M&A, we are engaging in M&A transactions. So in the last few years, we had few. So within the approach towards those transactions, definitely the tax aspect is a main one. This is material part of our due diligence. When we are approaching a company, we are checking it from various aspects of taxation, looking at the companies that we are about to acquire. We are looking about their tax structure. What is the transfer pricing that exists within those companies? Issues related to permanent establishment, how it will affect us. Issues related to tax withholding that might be imposed. VAT, indirect aspects. Gaming duties, how it comes into force and how it will be affected. Employment taxation. So a lot of aspects that are related to taxation take into consideration when you are approaching such a transaction. Apart from that, as now the industry going through a lot of consolidations, so also on the day-to-day, you need to make sure that the structure that you are holding, the structure that your company is built, is optimized. You are doing the things in the right way, putting the right companies in the right jurisdictions in order to make sure that you optimize, as I said, transfer pricing, VAT, and all of those aspects. Also, when coming for a transaction, how you structure the transaction, whether to do it as an asset transaction or to do it share transactions, a lot of elements that might affect this decision. And I must say that from my perspective, and you know it because we work together, you're on my quick dial list, you know, in order to discuss and how to structure it right. And in the last few years, we did a transaction that we bought companies, but also recently did a transaction where we divested our B2C segment. And also there, you need consultation, how to structure it, what is the best way to approach it, because it makes it easier also for the acquirer to take this transaction going forward. So this is the main, I think for me, this is the main aspect that I'm checking and contemplating when coming to do an M&A transaction.
I want the audience here to take away something with them in terms of new taxation laws, right? So sometimes when we're dealing with a merger and acquisition, we focus on the transaction, but we don't focus on what happens after. Now, we're seeing from an international tax point of view, we have Pillar 2 coming in, which is the 15% flat tax, right? So how important is that our clients are aware that sometimes when you merge, you will end up with other obligations because you would exceed thresholds. So, for example, the 15% flat tax which is being proposed is one of them, but also country-by-country reporting. So these are also things that I think we need to have the industry aware of. So not just looking at the transaction and how to create the transaction in the most tax optimization way, but also what happens after the companies merge. There's DEC 6 reporting obligation. Now there's DEC 7 and DEC 8. So all these things, I think the industry needs to be aware of, right? What's your take on this?
I'll respond in terms of the new Beps rules. And you're absolutely right. The OECD set a threshold of 750 million euros annually of revenue for two key tests. One is the country-by-country reporting, which is the enhanced Beps 1.0 reporting, and that's information which is detailed and exchanged between relevant tax authorities. And the other one is Pillar 2, which we're expecting to come in 2023. And this is an incredibly complicated new set of rules aimed, as you say, at reaching a global minimum tax rate of 15%. But how you get there is going to be incredibly complicated. And I think that what we see is perhaps two opposite trends here, because on the one hand, for smaller companies which have revenue below the 750 million euro threshold, they must understand that if they're consolidating and crossing that threshold, they will be subject to new rules. Obviously, there's also Pillar 1, which has a $20 billion threshold, which is a far higher threshold and probably relevant to to fewer companies. But the 750 million euro threshold is really relevant because a lot of gaming companies are in the context of an M&A transaction could cross that. And on the other hand, given the great deal of complexity that it brings, the fact that companies will be bigger and will have these economies of scale will be really crucial, because just the compliance, having a large enough finance and tax department and a large enough and capable enough advisors will be really crucial in terms of being able to comply with those new rules.
Eduardo or Motti, your take on this?
From my perspective, I will just reiterate what Daniel just said. This is something that you need to take into consideration, because such an M&A transaction can take you above the threshold, and the tax implications are material. So just to be aware of it from day one, to consult with your tax consultants, tax advisors, in order to make sure that you structure it in the right way.
We're not saying that the tax should take more relevance than the commercial deals themselves, because the commercial deals, obviously, they need to. But this is a very important point that I think most of the companies merging, they won't think of the results of what's coming after the actual merger. Eduardo, what's your take on this?
Well, just to add that when you are in scope of this country by country reporting or new ETA 2, I think you are in a new league, much more under the scrutiny of all tax authorities involved, which probably entails more compliance costs. Well, for sure, it entails more compliance costs. And I think at the time of the acquisition, if you are aware that you are going to go beyond that threshold, I think you should take more and more interest on what has gone in the past, what has happened in the past, because that may give rise to new reps and warranties from the seller, just in case you, as the inheritor of the business, will have to cope with tax authorities for whatever happened in the past, knowing that the past is going to be much more under control by the authorities after the acquisition. So that's important.
Okay. When it comes to new trends, right? So in mergers and acquisitions, most of the time there are indemnities from a tax point of view. But now we're seeing clients being more creative when it comes to indemnities. Maybe Daniel or any Eduardo or Motti can share your views on insurances, on tax indemnities, and how they're actually working, and also how they change across jurisdictions, because it depends in which areas of the world we're dealing with.
Yeah, and that is, we're seeing that more and more, especially in the biggest deals, the use of warranty and indemnity insurance or tax indemnity insurance. And it really creates a new dynamic. I think it encourages the buyer and the seller to cooperate more. Now there's a third party which is essentially stepping in and saying, if this tax risk crystallizes, subject to various baskets and thresholds and exclusions, the insurer will take on that obligation. From the seller's point of view, it gives them a greater amount of deal and consideration certainty. From the buyer's point of view, it gives them more comfort in terms of post-deal having a third party not needing to rely necessarily on an escrow arrangement or on being able to go after a seller which may have changed and merged again since the deal by the time that tax risk crystallizes. And I think particularly given that tax risks by their nature are have very variable range of outcomes. From it could be something which is which comes to nothing, and it could be something which comes to a massive tax bill. I think it really makes a lot of sense to be looking at the suitability of warranties and indemnity insurance, in particular in M&A deals.
Eduardo, Motti, you want to add anything on this point?
You know, on ATAT 2? On ATAT 2, you mean? Or, sorry, on ATAT 2. On Pillar 2?
Yes.
On Pillar 2. Yeah, well, there is a lot of unknowns there yet, although in principle it's something that is going to be approved and applicable from January 23. So it's really there. And therefore, it's important to keep an eye on what has already been approved, on what will be approved soon, so that if you are in scope, so above these 750 billion euros of consolidated revenue, this doesn't take you by surprise. It is, my guess is that most jurisdictions, such as the Irish government just announced, will touch up the tax rate for those companies only, for those groups, to 15%, so that the taxation on the profits remains in the jurisdiction, rather than allowing other jurisdictions to absorb that difference. That's probably something that we are going to see in many low tax jurisdictions over the coming year or so, and that may have a direct effect on your P&L, obviously, if you are one of those groups within scope.
Okay, so I think the takeaway home is to continue watching the space, and hopefully in a year's time when we meet for another Sigma, we'll have an update on Pillar 2 and whether this 15% tax will really affect us all. Thank you for your time. It was a pleasure having you on our panel. Thank you.
Thank you.
Thank you.